China's central bank has continued to add gold to its official reserves for 18 consecutive months. The latest report for April confirms this. Officially, the holdings stand at 2,322 tons. Financial media worldwide has been covering this relentlessly. Every analyst, bank, and financial YouTube channel is discussing it in some form. Yet, there is a figure that almost no one mentions. China's reported silver reserves remain at zero, not a single ounce. Silver, the second most significant monetary metal in human history, has accompanied gold in reserve systems for 5,000 years. The absence of silver is intentional. The regulatory actions China implemented in the first quarter of 2026 indicate that the situation is becoming critical. To see the full picture, the People's Bank of China began its current gold buying streak in November of 2024. Every month since, without exception, they have added more. According to the World Gold Council, official holdings reached 2,322 tons as of April 2026. Independent analysts at Societe Generale, using trade flow data, estimate the real total could be 2 to 10 times higher. The Shanghai Gold Exchange enforces mandatory physical settlement. Once gold leaves a certified vault in that system, it cannot return to the auditable ledger. China has been leveraging this structural gap to accumulate metal at a pace that does not appear in IMF filings. The publicly reported number represents the floor, not the ceiling. China is not merely hedging. It is building an alternative monetary foundation that operates without the dollar, SWIFT wires, or Washington's permission. Most analysts stop at the gold story. They see gold accumulation and interpret it as a hedge against the dollar, geopolitical risk, or a Fed alternative. That reading is correct, but it captures only half the picture. China controls between 60 and 70% of global silver refining capacity. This is significant. It means that silver mined anywhere, Mexico, Peru, Australia, has a better than 2 in 3 chance of passing through Chinese hands before becoming usable. China has developed this infrastructure over 2 decades, quietly and systematically, with the same long-term discipline that built its dominance in rare earths. Here is the question almost no analyst asks. If China is building a gold reserve at this scale, buying every month for 18 months, why does it report 0 silver? The obvious interpretation is that gold serves as the monetary metal, while silver is treated as an industrial material. On the surface, this appears to make sense. Gold is accumulated, while silver is consumed in solar panels, electric vehicles, and semiconductors. However, data and regulatory changes in early 2026 complicate that narrative. Effective January 1st, 2026, China imposed strict new export controls on refined silver. Only 44 companies received approval to export silver. To qualify, a firm must have an annual production capacity of at least 80 tons and maintain substantial financial reserves. This requirement excluded hundreds of smaller refiners who historically linked Chinese production with Western industrial buyers. In February of 2026, the Shanghai Futures Exchange made 2 additional adjustments. First, it increased financial requirements for holding silver futures positions, making participation significantly more expensive. Second, it limited who could take physical delivery of silver on the exchange. Participants without approved hedging quotas received 0 allocation. Consider that carefully. China restricted physical delivery of a commodity it supposedly has in abundance. You do not impose delivery restrictions when supply is plentiful. Such measures occur when physical stocks are being consumed faster than replenishment. When paper traders risk depleting the stockpile while industry still requires the metal, controls become necessary. The SHFE has not publicly acknowledged stress in China's silver supply, but February data from CIC shows warehouse silver stocks around 420 tons in early February, down sharply from previous levels and far below historical norms. 5 years ago, peak inventory exceeded 3,000 tons. The significance is clear. The Silver Institute's World Silver Survey for 2026 documents the 6th consecutive annual supply deficit globally. Over 760 million ounces have been withdrawn from global inventories during the past 5 years. China's domestic industrial demand for silver and solar panels alone, requiring over 500 tons for 1 year of installation capacity, is likely surpassing domestic mine production. China mines approximately 13% of the world's silver. It refines 60 to 70% and consumes a large portion of it before any export licenses are issued. The January 2026 export controls were not a simple resource protection. They reflected recognition that the country controlling the global silver pipeline was beginning to run low on buffer. There is also the gold to silver ratio. Today, it stands near 58 to 1. 60 years ago, bimetallic monetary law fixed it at 15 to 1. When governments abandoned the peg in the late 19th century, silver lost its formal monetary anchor. The ratio drifted, and during the COVID crash of 2020, it spiked above 100. Silver, historically cheap, has since compressed sharply. It reached an all-time high of $12,164 per ounce on January 29th, 2026, before pulling back into the current range. Chinese analysts are aware of this history. In 2011, Xia Bin, a senior official at the People's Bank of China, publicly stated that China should increase gold and silver reserves and buy during dips. That statement has mostly faded from memory. The gold purchases are visible, but silver positioning remains undisclosed. China's official silver reserve reported to the IMF remains at 0. That number has not changed for years. Even a small increase would be the most significant announcement in the precious metals market in a decade. The moment China formally recognizes silver as a reserve asset, every central bank in the world must adjust its calculations. Here is what it means for markets. The paper silver market, with futures contracts traded on COMEX in New York, prices silver at one level. The physical market, where actual delivery occurs, trades at a higher price. That difference is not minor. It reflects the tightness of the physical supply chain. China's domestic consumption is absorbing more of its refined silver. January export controls and February SHFE delivery restrictions are the first clear signs that China is diverting physical supply from international markets. This gradually thins the pipeline feeding COMEX inventories, London vaults, and Western industrial buyers. This is not abstract geopolitics. It directly affects the value of every silver position. The mainstream financial media focuses on gold, but the story of silver's supply chain is being overlooked. Watch several indicators closely in the coming weeks. Monitor the PBOC's monthly reserve disclosure. Even the addition of 1 ton of silver to the IMF filing would immediately shift the value of every precious metals position worldwide. Track SHFE warehouse silver stock numbers. Continued declines would show a real-time drain of physical supply. Keep an eye on the gold to silver ratio. At 58 to 1, it has already contracted sharply from the COVID peak. A sustained move below 55 would indicate a structural repricing underway. China moves quietly. It builds positions before announcing results. The January export controls were the first public step. The SHFE delivery restrictions were the second. The next announcement, whenever it occurs, could reshape silver prices for a generation. The paper market treats silver as a commodity, but the physical market is beginning to price it differently.